over the last 100 years, this has been like the best time to ever be in real estate.
Yep, absolutely.
And now it comes off the cuff of the worst time to be in real estate, which was 2008. But so we got 10 years of really, really good times. So over the next few years, I mean, with inflation, because I've read different reports, even from Fed managers, different regional managers are saying like this is crazy. The Fed's not doing enough. Like they need to be doing like 3 times what they're doing, which is insane to think about. Do we have maybe 10 years of, even if it doesn't, we don't actually have a recessionary pricing, which I don't really see. I see some people talking about that. Do we have 10 years of flatline, like to catch up, or maybe 5 years of flatline, very slow growth? By flatline, I just mean 0 to 5% growth versus 20 plus.
Yeah, I mean, I think it's certainly going to affect the appreciation. Look at especially the last 3 years, the appreciation has been insane. Especially from an investing standpoint, it's dangerous. I mean, it's good for the market. It's dangerous for investors because it turns investors into lazy investors. And what it does is it allows you to make a mistake on a flip or whatever it is you're doing and still make money.
The market will help you out.
Yeah, and so it also makes investors more aggressive because now they're betting on the come. They're betting on that appreciation. So I think it's going to slow down a lot of that money going into the market. As far as appreciation, I think it will slow it down. Inventory has been one of the big factors that has caused appreciation to elevate so rapidly. Mm-hmm. So I could certainly see a flat line. You could even see some markets moving down. Maybe some outlying markets that have been affected by the low inventory. You have a lot of investors that have moved into, maybe not in the major metropolitan areas, some of the smaller counties outside these major metropolitans, and even maybe some of the suburbs of major metropolitan cities like Houston and Austin and Dallas and so forth. I think those typically get affected first. Interloop areas, inner city areas, you typically don't see a lot of depreciation. Maybe we'll see slower appreciation, but I don't see anything as far as a rapid depreciation.
Yeah, and ultimately, I think cash flow becomes even more important because if you're not going to be making it on appreciation, which, I mean, you have two. You've got cash flow, and then you got appreciation. That's ultimately, I mean, excluding equity gain and tax benefits. Those are really the two main ways you're making money as an investor. Or as a homeowner, it's more, I guess, savings versus rent and then appreciation. So that means cash flow. Like if you're not buying for cash flow, you're putting yourself at real risk in the event of appreciation flatlining or even receding a little bit.
Yeah, I mean, if typically you're betting on one or the other. You very rarely do you get both appreciation, at least rapid appreciation and cash flow. But I think a lot of investors have seen that the last 3-4 years.
So, yeah, it's been really glorious times for landlords. It's been
absolutely
tough for a lot of folks, but
yeah, the value of their properties have gone up a lot, and they're getting good cash flow. I think the cash flow is really what's going to get pinched the most in the coming months, because as the rates are moving up, the rents haven't been able to move up quite as rapidly. I think we're going to see a lot of rent increases in the future. But certain markets are not going to be able to keep up with that because you have affordability issues. So I think if you're an appreciation investor, you're always going to be fine because the market's always going to eventually appreciate over time. Cash flow, you're going to have to be a little more selective about which market you're in.
Yeah, some of the advice and let me know what your thoughts there here, for investors, I've been telling folks, like, look, if you're buying to flip, you need to be a bit more cautious. Like you need to be very, very stingy on your numbers. And maybe even add for some, X factor that you don't know, because the market has been forgiving for bad projects. But if you're buying long term, the worst thing that can happen is you got to put a little bit more money down, and that'll cover your cash flow problem. Because typically rents you don't necessarily see a receding in rents. You definitely can. It's not impossible, but at least in maybe not in the New York area and those kind of areas, but usually as long like over time, it fixes itself. It will appreciate. Rents will go up. So it's mainly just your initial debt service that maybe you just got to put a little bit more money down to make sure cash flows.
Yeah, that's one way to do it. And you also, when you're looking at a rising interest rate environment or when you're possibly looking at a recession, if you're flipping houses, you need to be thinking about multiple exit strategies. Multiple exit strategies can help out a lot. You have to have that mindset. Maybe you're not able to flip that house for what you thought you were, and maybe it ends up on the market a little bit longer. So you need to figure out what else you can do with it. Do you just keep it and rent it? Do you own or finance it? I mean, there's all kinds of different ways to create cash flow, and that's what you're going to have to do if we do hit a recession and the real estate market takes a hit.
Which is precisely why I tell folks that are buying Airbnbs, short-term rentals, like, look, you're buying this and that's your only exit strategy because you're paying retail and it does well as an Airbnb, great. But your problem is if it doesn't cash flow long-term, because maybe a COVID situation happens where you can't short-term rent it, or you get saturated and the short-term rates plummet, you're in a bad spot. Now your only exit is to sell it. And can you sell it for a profit?
Yeah, if Airbnb is your only exit and you're banking on that type of cash flow, because you make a lot more money on Airbnb, if you need that type of cash flow, that's certainly a dangerous spot to be in. Multiple exit strategies are everything.